Hey, everybody, welcome to another episode of the Under the Hood podcast hosted by Stallion Capital. Today on the show, we have Terri Spath, who is the Chief Investment Officer at Zuma Wealth. Terri, how you doing?
I'm great this morning. Thank you, Timmy. How are you?
I am doing well. Thanks so much for asking. And we're super excited to have you on the show and hear a bit more about you. Let's go ahead and start with you just telling us a little bit more about Zuma Wealth, about your journey as an advisor. Give us your backstory.
Sure. I have a maybe a little bit different path. I'm not sure, but we started Zuma Wealth, one of the founders, because we found that most people, everyone actually, deserves to feel financially empowered, but a lot of people don't know where to start, and we recognize that in that people need like personalized financial guidance, but they don't know who to trust. They feel overwhelmed. They feel overlooked. They feel underserved. They worry they're not getting the attention they deserve. They're concerned they might be taken advantage of when it comes to their wealth management. And, we understand that. And we understand that people deserve holistic, customized guidance so they can do with their wealth as they please. And it's why I took all of my experience managing billions of dollars over the past bull and bear markets of the past 25 years to create Zuma Wealth. My history was starting out of grad school with Franklin Templeton, that huge mutual fund company on the West Coast. I was then in the investment management team as the deputy chief investment officer for Mercer Advisors, one of the largest RIAs in this country. Most recently as CIO of a firm in Santa Monica. And like I said, we decided to start Zuma Wealth because we still felt like people were not quite getting the information and the guidance that they needed to feel completely empowered and free with their wealth.
I gotcha. So that's something we've actually heard over at Stallion Capital. Some people were more localized debt fund in real estate, more on the alt side. So we're not completely wealth management, but we've had people come to us saying, I'm trying to call the people in New York and I just can't get a hold of them. There's no personal touch to my wealth management and I don't know what's going on. So were you finding a lot of that and that really made the shift?
Absolutely. I mean, I think a lot of places are one size fits all. And rather than taking individual considerations, they might say that or give some lip service to, hey, we're going to do something just for you. But really, the reality is it tends to be one size fits all solutions. And when it's something like what you're talking about, a little bit more complicated on the fixed income or the debt side, which is an area that I find fascinating. When I was at Franklin Templeton, I started as a high yield bond analyst, and I've consistently invested in the debt side. And it can be a little bit more complicated for people, and they gloss over, they don't understand it, and they can miss out on some great opportunities in the debt side.
Absolutely. Well, I like that you started Zuma Wealth with the intent of giving that more personalized attention, making sure customers felt like, they were seen, they were heard. I'm curious though, is scaling a practice and giving that personalized attention difficult, or have you put systems in place to make sure you can handle everybody's needs well and still handle the business aspect of things?
Well, that's a great question because some of the biggest firms out there, that's why they have a one size fits all for hundreds of clients at a time. And we started our firm, as you've been pointing out, to be much more customized. And we're focused on staying as an emerging boutique-sized firm. But that said, we still have systems in place because you have to in order to deliver the best customized service. So what I like to say, I don't know how well this will fly, but on the process side of things, it's a McDonald's approach, right? Everywhere you go in the world, your McDonald's French fries, whether you eat them or not, are going to taste the same. And so you want some processes in place to make sure that that you've got a consistent service model for clients. So we have that. We have processes in terms of how often we speak with clients, the agendas that we're going to cover for them, how we the questions that we ask to make sure that we're setting up the proper allocations. But after that, that's when the customization comes in place and we can deliver a unique solution for each individual client that we have. So it's a combination, I think, of making sure that things that can be systemized are, so that that's a consistent process and a consistent experience for people, but at the same time deliver something that is unique to that individual in their journey in their life.
Yeah, I love that. It sounds like the systems can serve as a foundation point for that initial communication. And it's like, hey, typically we'll do quarterly communication or monthly communication, but if you want every 2 weeks you want once a year or twice a year, we can make that work as well. And it gives a good kind of perspective for the customer to kind of understand where you guys are coming from and then communicate their needs and desires as well. So I like that a lot. It's really cool. And now I'm curious when it comes into customizing interactions with customers and eventually that leads to portfolios, you obviously need to know about the market. You are the chief investment officer. So where do you go to stay up to date on market trends and market strategies that are optimal for the current market?
Yeah, great question, Timmy. I mean, there's so much information out there, and it's just a lot of it's noise, but you need to understand what's going on in the broad markets. And, it does help that I've been around for a while. I've been in really tough markets, I've been in really great markets, I've been in everything in between. And there are certain patterns that, I feel like I can identify and ways that we can help separate the signal from the noise, because the reality is investments tend to take the stairs up and the elevator down, meaning you make money a lot more slowly than you can lose money. The stock market can drop, or a bond price can drop, or other investments can drop much more quickly than they went on the way up. So some managers are stock jockeys. They're always looking for the hottest, idea out there. Others are kind of set it and forget it, and they have a strategy, but they don't really adjust for the dynamics of the market. So we combine kind of fundamental information about asset allocation and putting things together, stocks, bonds, alternative investments, putting that together in a strategic way, and then having a technical overlay that allows us to adjust for what's going on in the markets in real time without being constantly reacting to whatever the latest headline is. It's always interesting to me this time of year. There can be these great reviews out there that show, movements in the stock market, for example, with headlines, and there's really just no connection, but they're so loud, they're so noisy. So what we have found is a great solution is to create strategic allocations and then have this sort of technical information that's feeding in on a daily basis to kind of adjust on the margins to make sure that we're that we're participating when the trends are to the upside, when markets are taking those slow stairs up, but making sure that we're protecting downside for clients in those periods of time when things drop and drop very quickly.
I see. I see. So it's really more maybe not being super locked into the daily news because you want to craft a strategy that optimizes the portfolio despite daily news. And it's like, hey, this daily news may have this headline, but it's not as correlated to your wealth planning as you may think. So we want to protect you from that. Is that accurate?
I think that's accurate, and it's always that's always a challenge for people who aren't necessarily watching the markets as closely as perhaps you are, perhaps I am on a daily basis, and haven't done so through up and down markets for long periods of time, because it seems like, oh my gosh, for example, this year is an election year. We've got a number of clients that are very concerned with how the elections are going to impact their investments and have very strong views on what that's going to translate into. And when we look at the historical research and data out there, it's really hard to find a consistent connection between that news cycle and how your wealth is impacted, how your investments are impacted. So we're trying to strike a balance between certainly being very aware of what's going on in the world and how that's impacting people and how they feel, and what that translates into on a day-to-day basis and a year-to-year basis on their investment portfolio.
I gotcha. That how they feel part can be very
Yeah.
important because a lot of us.
Yeah.
I say a lot of us, literally all of us are human and we make human decisions, which are by and large based on emotion. And so being able to navigate that well with how you construct a portfolio and how you manage that client relationship seems like it would be key. Now, I noticed you mentioned election year. And so I kind of want to segue into current markets. We don't necessarily have to talk about any particular aspect of the market, but I do want to know when you are constructing portfolios for clients, what current market aspects are you really paying attention to? And then what are your high level strategies to address them?
Right, right. So, right. So, like, kind of narrowing it down the funnel, because obviously you have a strategic kind of view of what to do with a portfolio in the longer term. But, there is the reality that things move up and down. And in the current state of the market, I mean, we're always seeking stable return. This is something that I think Stallion does very well. Stable returns, predictable returns, consistent returns. I mean, that is the ultimate goal, right? If you can achieve that, I think that's huge success. So we're always seeking that. I think one of the big factors, well, I know one of the big factors that's been occurring over the past few years and will probably occur this year is like, what's going on with the Federal Reserve? What are Jay Powell and friends going to do with interest rates? And that's been driving not just the short term interest rates that the Fed controls, but medium term interest rates, longer term interest rates on safe debt instruments, on riskier debt instruments, on the U.S. stock market, on the international stock market, on every alternative investment that's out there. There was, for a number of years, that TINA environment. You don't hear that anymore. It stood for there is no alternative, which meant all you could buy was stocks because you couldn't make any income on bonds, whether they were safe or risky. It just wasn't worth it. The alternative environment just wasn't as appealing. It was the TINA environment, and that is gone. That is in the rearview mirror. It was kind of a cute little acronym at the time. But I think that what's going to drive the markets in 2024 is on a more macro basis is what has driven it in the past, which is what's going on with the Fed. Are they done raising interest rates? Is the economy going to kind of glide to a nice soft landing? Is it going to slam to a tougher recessionary environment? So that element of what's influencing every investment option that's out there is something that we're paying a lot of attention to in the current market.
I gotcha. And do you have specific things, maybe you can speak to it, maybe you can't right now, where you're kind of gearing up for, okay, if they raise it this much, we're probably going to change our portfolio allocation like this, or if they start decreasing it, these options open up. Are you brainstorming some of that, or is it more like we're going to wait and see, and then we're going to communicate with our clients?
Well, no, I mean, we do actually have a viewpoint on that, and we've been pretty vocal about it over the past year. And again, with the goal of always achieving the sort of consistent, stable, predictable return for clients. Like, what's the best way that we can navigate that? And it's been our view that the Fed, well, they were late to the game. I don't think there's any debate about that anymore. That when you throw as much money into the economy as the U.S. government did and the Federal Reserve did kind of during when COVID first hit and shortly after that, in order to kind of buoy people and help them out in very, very unusual and challenging time. But when you throw all that money into an economy, it's just textbook that you're going to have inflation. It just is. I mean, I was an econ major. As one of the first things we learned is that's how inflation is created. I also, on a sidebar, I'm going to go a little off script. I was also a psych major because we
So was
touched
I.
on human behavior. We touched on human behavior a little bit, so I wanted to bring this up. So I was an economics major because I loved the logic of it all, and I loved how it described what was going on in the world. But I was also fascinated by human behavior. So I also was a psych major. I actually had two majors. We didn't have minors in college, so I was sort of forced into choosing two majors. And it was very interesting because in econ, the starting premise is that every person, every organization, every corporation, every government in the world acts in a rational way. when it comes to making decisions about money.
Yep.
Then I walk across the hall to my psych class, and the starting premise was the exact opposite. Nobody's
Yep.
rational. How can we help them, navigate this thing called life? So it was
Yep.
a very interesting combination, a very helpful combination for our industry um, that we're in. But getting back to your original question, which is kind of, how does this influence what we're doing for clients right now? Is that we had inflation, significant inflation, and the Fed and a lot of their advisors were saying, "Hey, this isn't going to last long. This is transitory," and we felt very strongly it was not transitory. When you put that
Yep.
much money, billions and trillions of dollars into an
Yep.
economy, it's going to create inflation. It just is. And what you have to do to rein that in, if you want to rein it in, is to raise interest rates. Because what does that do? You have higher interest rates. It makes things more expensive, such as purchasing a house, such as purchasing a car, such as borrowing to start a business. And what that does, if you have a higher interest rate, it makes it more expensive, it slows things down. And, towing that line between managing inflation but not killing the economy has been something that the Fed has been working very hard at doing. And when they first started increasing rates, we thought they were late to the game. They were. Then they did it so quickly that it was a real shock to every
Yep.
person and corporation out there. And now they're finally kind of tapped the brakes on that, and we think they're done. We've been saying that now for several months, and it looks like that's going to continue to be the case. So that sort of rapid increase in interest rates um, slowed down towards the end of 2023, and we think we will stay where we are and probably go lower going forward. So how
Mm.
that translates is, locking in some of these higher interest rates that we don't think we're going to see going forward. If rates are going to start to drop, we might in 2 or 3 years look back and be like, wow, if I could only get that 4 or 5% or higher and riskier debt, I wish I could have it now. I think that people will be saying that in a couple of years. And so we're making sure to incorporate that into our client portfolios, make sure that they're benefiting from those high interest rates that have defined the past couple few years.
I gotcha. So it's really seizing the opportunity as it is because you feel like in a couple years people are going to be missing out on kind of high interest rate returns they can be getting right now.
Absolutely. Absolutely, to me. I mean, I really do feel like we've seen the peak in rates. I don't think the Fed's going to continue to raise rates. I think there's a very high probability they're going to cut rates because they raise so rapidly and there's such a hard impact on the economy, and it takes a while. It's like slamming the brakes on in your car and everything from the back seat comes flying forward and hits everybody in the head in the front. That's really what the Fed did. They just slammed on the brakes by raising rates as fast and as sharply as they did. And they need to be careful now for everyone in the front seat that's getting, hit in the head with whatever you whatever you left in your back seat. And that's sort of maybe a colorful way of saying that these higher rates that the Fed introduced are not going to last forever. And so how do we seize the opportunity for our clients to make sure that they can benefit from the higher interest rate environment, those consistent returns that debt can often offer in going forward?
Yeah, for sure. That makes perfect sense to me. And so we've kind of considered the what the Fed's going to do in that aspect of the current market, and we link that to how that helps us look at portfolios from the increasing yield by taking advantage of some of that higher yielding debt right now. I'm curious though if you have anything to add from how the current market is looking from a risk management perspective. Is how the Fed has acted in the past year and how they're going to act going forward not changing your stance on risk management, but informing your stance on risk management in a way that you would like to share right now?
Sure. That's a very interesting question to me. Yeah. So the Fed, like we've been talking about, has been sort of the overarching influence on many different investment opportunities. I think, and there's always risk out there. There's always risk. We touched briefly on this is going to be an election year, and it's going to be an interesting one. It's same old thing all over again, but at the same time, it's confusing people out there. It's confusing voters. It's maybe influencing how confident they feel about their jobs, about their lives, and those are always risks. So that would be kind of, I think, the second thing that we're paying a lot of attention to in terms of not necessarily a direct impact on investments, but on people and how they feel about their lives, and that influences the risk environment. That said, there's always risk out there. There's always the chance to make money, and there's always the risk of losing money. So how do we perceive that right now? We're constantly watching the data that comes out on the economy. We're constantly watching the data that comes out from companies as they report their earnings. And, I have to say, we're a little bit surprised that the risk environment seems to be becoming a little bit more tepid, a little bit more manageable than we might have expected. There were a lot of things a year ago at this time, primarily an inverted yield curve, meaning short-term interest rates were higher than long-term interest rates, meaning you could make more money on a 3-month T-bill than you could on a 5-year Treasury bond in terms of the interest. And that's a very unusual situation. It typically points to a recession in the US economy and higher risk for investors. And despite that inversion that we've been observing for well over a year now, it does appear that we may be kind of gliding into a more soft landing for the US economy, meaning the risk environment is becoming a little bit less. And that's good news. That's a tailwind for most type of investments out there. And so from a risk perspective, it does appear from our chair that things might be a little bit better in the coming year than maybe we had feared a year ago at this time.
Yeah, and so I've heard a couple of other advisors that I've talked to just speak about that inverted yield curve and how two kind of historical things have happened: the historic rise in interest rates, and then like the yield curve being inverted and the recession not really triggering how we thought it would. And so do those things cause pause for you going for it? It's like, hey, it doesn't look as risky, but this is a new environment? Or are you like, no, I trust my indicators, I know the data going forward, and we're moving forward strong? Does that question make sense?
What we look at are actually something that we call the four horsemen of the apocalypse, which is actually from the Bible. And when the four horsemen are coming, that means, the end is near. And for us, there's four key indicators that we look at, one of which is the yield curve. When that is inverted, that is a bad sign for the economy. That is one of the four horsemen of the apocalypse is coming for the U.S. economy and for investments as a result. However, there are three other indicators that we look at, one of which is we look at the employment rate relative to its 12-month moving average. And when we look at that actually looks okay. We look at housing starts, and that is a third indicator that maybe is a yellow light, but is not a red light, meaning it's not one of the four horsemen of the apocalypse is, not visible. So housing starts are okay. Employment looks good. The next indicator is consumer confidence. That actually is still fairly robust. So we have four indicators, the four horsemen of the apocalypse that we look at that help us define, what should we expect in the next 6 to 12 months for the economy. One is absolutely present, which is that inverted yield curve. The other three, however, give us pause and make it appear that, okay, that one indicator is definitely flashing and is not good, but it's not the only thing that's out there. And that's been an offsetting factor. And we think that's why while we've been a little bit surprised because whenever you see one horseman, you get nervous. But the other three seem to be indicating that things are hanging in there, and that maybe people don't feel, maybe not everyone out there feels great, and we want to be aware of that, and we want to be cognizant of that. It does look like, from an investment perspective, that we're gonna move on through and do okay.
Yeah. Okay. Well, there we go. I like to hear it. That is good news for me. So, really appreciate that kind of deep dive into the four horsemen of the recession or apocalypse or whatever you would like to call it. I am curious though. So we've talked a little bit about the risk management perspective, how to understand that, navigate that in the current market, kind of what you're looking at based on the Fed's behavior in the current market. But let's go to portfolios. Tell us a bit more about
Yeah.
specifically when you're constructing a portfolio optimized for accumulation versus a portfolio optimized for income slash retirement. What are you looking to do from a kind of fundamental structural perspective of like percentage wise, and then maybe some specifics if you want to go there as well.
Okay, we'll take a stab at that. I mean, ultimately, the goals, whether you're in accumulation or you're in retirement, again, generally, is we're looking for consistency, we're looking for stability, we're looking for predictability. So, how do we construct that? And, something that we've often said is that the 60/40 portfolio is dead, and it
Mm.
has been dead. Now, what does that mean? The 60/40 is 60% stocks, 40% bond. That portfolio, which is maybe closer for retirement, but is also often used in some form um, for an accumulation portfolio, just different numbers. We just think that that's dead. Now, why do we think that? There's two main reasons, I guess. One main reason is that the bond side of things, the 40, is a lot more dynamic and less correlated to stocks than people often think. So we want stocks for growth, right? That's a pretty consistent, reliable asset class for investors, is to have some exposure to stocks. And then we want some exposure to bonds, but we're utilizing that a lot differently now than I think people were trained 20 years ago. The I guess myth is that when stocks go up, bonds are sort of flat or down, and the flip, when stocks go down, your bond portfolio is going to save you. That really just hasn't worked. I mean, I think that's been very clear over the past few years, that very often stocks go down and so do bonds, and you don't want
Yep.
that situation. So what we've introduced for our clients in creating our firm at Zuma is exposure to alternatives as well. Now, alternatives are a broad bucket for anything that's not a stock and not a bond, meaning a liquid bond. So private debt would fall into an alternative side of things, private equity, things of that nature. And we want to make sure and incorporate that, whether you're in accumulation phase or in a withdrawal phase and looking for income, because we sincerely believe that that can benefit really any risk tolerance, any age, any stage in your life. Having the optimal exposure to stocks for growth, the right kind of bonds, but also alternatives to create some consistency, some predictability, some growth. Those come in a lot of different flavors. What we tend to like actually is private debt, because it has a higher income. It's a consistent, predictable, maybe not 100% predictable, but pretty, clearer path of outcomes. And we want to incorporate that into our clients. So somebody in an accumulation phase, we're going to have, higher exposure perhaps to certain types of alts and certain types of stocks, less towards, more consistent treasuries. And for someone with income, maybe we increase a little bit of that treasury exposure. But those are the three broad buckets that we want to make sure that we incorporate into anyone that we're working with.
Okay. Okay. So let's talk about alts a little bit more because that's typically the next section of the show. You mentioned private debt, but specifically, how are you evaluating alts when you're thinking about bringing them into a client's portfolio? Just high level. You don't have to go into the nitty gritty due diligence of it, but
Yeah, no, I've taught an entire class for the CFA Los Angeles on alts.
yep.
So yeah, we can go into a 2 hour discussion if you'd like, but I don't want to do that. And I'm sure nobody listening wants to hear that. But I think the message is that there's so many different flavors of alts, so many different flavors. I like ice cream. There's the plain vanilla, there's the, mint chip, which is my personal favorite, so many different flavors. And that's the same thing with alts. It captures so many different, frankly, opportunities, but also, things that are just not worth putting into a client portfolio.
Hmm.
There's many alts that are out there that are high fee. They have a spotty management team. They don't necessarily have a consistent, loyal management team. There's unreliable outcomes. So to start, we kind of go in that funnel of everything that's out there and that would be considered an alternative, and get rid of the ones that, again, have a spotty management, have unreliable outcomes, that are just high fee and don't really add any sort of benefit for a client portfolio. And that gets rid of a lot that's out there. And then what we're really looking for, when we look at alternative investments for our clients, are options, opportunities that are low correlation to what we can get in the public liquid market, that offer what we believe is going to be a consistent, predictable, stable return, and bring that into the portfolio at the right level that we think will reduce risk but improve returns. I mean, that's what we're all trying to do on a daily basis, right? Is get better returns with less risk. And there are definitely alternatives that are out there. And what we try to do with our own clients is educate on that, because a lot of people out there aren't even aware that these exist, and then they can't begin to evaluate how that can be incorporated into their portfolio. And that's where we can really add some value for our clients, is by doing that homework, sharpening our pencil, getting rid of the high fees, getting rid of the bad outcome, bad management sort of options that are out there, and bringing in some high quality, lower risk, better return opportunities for our clients, and introducing that into a portfolio.
Yeah, yeah, absolutely. So it sounds like your initial screening is like, okay, what is there good management? Are there reasonable fees? If they don't have that, they're out. And that can cut out maybe 70%, the majority of alts. Like it cuts out a decent amount. But then after that, it's like, okay, we're trying to increase return, decrease risk. Is there consistent, stable performance from this alt? Very much the same thing we've been talking about throughout this whole show when it comes to stocks, bonds, putting the alts in there, stable, consistent performance of a portfolio. Does that kind of sum it up right of what you're looking for in the alt space?
Absolutely, and I think that part of the investment decision is the one that requires, honestly, it requires more effort. It requires more sweat. It requires more study, and most of the information for any stock or any bond that trades on a liquid way is out there already. There's not a whole
Yeah.
lot that you can discover as an investor that isn't already out there. That's a totally different story when you're looking to alternative managers. There's a lot of information that you can uncover and discover by kind of doing some homework around that, and it can introduce a lot of benefit for our clients, and that's really where we think we can add value, is by evaluating those managers, because we can't do those investments ourselves. We just don't have the expertise. I don't have the expertise. My team doesn't have the expertise, but there are teams out there that have terrific information, relationships, opportunities, and if we can discover those and put them into an investment portfolio, that's a huge value add for our clients.
Yeah, yeah, absolutely. And so, without giving an endorsement here, are there any particular alternative investments that you've really been intrigued by in the past couple months or year or so in your, just networking and due diligence efforts?
Without naming names, but I can absolutely say that the private debt market is one of the most intriguing areas of alts for us right now, and that's because, well, Um, there's a bunch of reasons. You can make a more consistent income in private debt than anywhere else that we can find. And, yeah, it's great to get 3 month treasuries into a portfolio and say, hey, you got a guaranteed 5%. Now, 5% used to make us yawn a little bit, but when it's guaranteed, okay, I can't say guaranteed. When it's pretty much guaranteed, that's
Yep.
great, right? Like there's a portion of your portfolio I can guarantee you're going to get 5%. There's a stock, side of things where we can get some growth, but it's going to be a rocky ride. But private debt, you can get better income. It's got a low correlation to what our clients typically have. Um, it's a very good, we've talked a lot about the economy. If we're in a good situation here in the global economy and in the US economy and in economies within the US, different states, different areas, it's an outstanding way to get some consistent, predictable, high income returns into a portfolio. And I'll also add, you know many investors simply hold too much cash in their portfolios. We tend to skew with our client base, actually even more women. Um, that's partially because that's the clients that have been drawn to us, and partially because we've targeted that. And we've done some research, and there's other research away from the studies that we have done that over and over again show that many investors, and even more so when you're focusing on women investors, they actually hold too much cash in their overall wealth. And the reason for that, when we've dug and kind of gone, pulled back the covers a little bit, it's like many people say, I just feel safe knowing exactly what I've got. And I can look at it and I know exactly what it's going to be. That's a terrible reason to hold cash. I get it. Like it feels good, like it makes you feel more comfortable. But over time, you're losing out so much. And so when we can show in a private debt in particular, you don't need to have that money. It doesn't, we can lock it up for a little while and earn the types of returns that we can often see over a period of time. It's a significant improvement for someone's overall wealth.
Yeah. Yeah. No, I love that. And specifically, kind of finding that gap of like, okay, we have a lot of clientele that do have a lot of cash, and we could put that portfolio to use, or that part of the portfolio to use in a more effective way for their overall goal. That is like the core of being a fiduciary. So I applaud you for taking the time to find that gap and fill that need for your clients. And speaking of clients, I do want to jump to a little bit about what you think of the client advisor relationship. What are the most important aspects from your perspective to that relationship?
Thanks for asking that. Like, what's the most important thing about a client advisor relationship? I mean, I think I used to say that the number one thing is you had an advisor that has, the credentials that are important for, delivering what you're paying them to deliver. And I still feel that way. I mean, I have a lot of credentials. I made sure to get the gold standards when it came to investment management in terms of the Chartered Financial Analyst designation, certified financial planner certification, tons of education, so that I felt, I could, make the best informed decisions for clients. Something that I've learned though over my career is that that's all well and good, but if your client does not feel comfortable with the person that they're speaking with, you're just not going to be able to help them. And like we just talked about, you can't help someone who's holding too much cash. You can't say I've got this great opportunity in the private debt market and it's gonna make your life better over time if they don't have that feeling of trust, and ability to communicate with someone. It's it's not helpful at all. You can have all the education in the world and have done all the work on the manager that you're introducing, and you can't kind of get the cash invested.
Yeah.
Um, so obviously, making sure that someone's comfortable and can trust the person that they're working with, that's key. But then make sure that you're working with someone that is, particularly, we're talking about alternatives. This is a more complicated type of investment. You need someone that's got the, I think, expertise and education and the relationships to fully analyze something such that when they bring it to your attention, that can deliver a better risk adjusted return that significantly impacts your life. So it's kind of a complicated, I think, question, as simple as it maybe sounds to start. You need that trust, but you can't just kind of blindly trust either. You need to make sure that you're working with someone that's got it, got not just the education, but also I think the perspective that comes from living through the bloody punches of tough markets as well as the great markets. Someone that's been around through that, I think, is something that people should look for in an advisor.
Yeah, I was listening to a John Maxwell video recently, and he was talking about how at the core of leadership, and I'm not saying that relationship is like leadership per se. It's a different type of relationship, but at the core of leadership, which is a relationship, was competence and character. And yeah, it was a leadership relationship, but I think that's important to every relationship, that there's people you can trust. You can trust their character and you can trust their level of competence with what you're involving them with in your life. So, if that's a friend, you want them to be a competent friend. You want them to be able to listen and not always think of themselves. But if it's an advisor, you want them to be competent in their field that they are helping you in as well. So I think you spoke to those 2 points really well, which is at the foundation of
100%. I mean,
most relationships. So, well, really cool. Last question for you. There are a lot of advisors out there. How can people really tell Zuma Wealth apart from other firms?
well, we think we think we're doing a much better job for people, but why do they? Well, how can they tell that? Um, we created Zuma Wealth, as you were nice enough to ask about at the start of this interview, because we felt as though many people out there feel overwhelmed or underserved in their financial lives. And we understand that. And it's why we've taken all of our expertise and our experience over, like I said, a couple of decades. Managing billions of dollars for hundreds of families at some of the largest firms out there. And so we believe that expertise and that experience um, helps us to deliver better risk adjusted returns for people. And, as boring as that sounds, that's really going to make a difference for people over their lifetimes. The benefits of compounding, the basic premise of investing is you want to compound your wealth. And what that means is you make money on the money that you make. And that turns into a hockey stick over time. We understand that concept. We want to deliver that education to people. And we also want to make sure that they do that. And I think that by doing things a little bit differently, not delivering one size fits all, making sure that we've got sort of the latest alternative investments that are available and appropriate for our clients, making sure that that's part of portfolios and that we've studied those, makes a huge difference for someone's outcomes over their lifetime and their wealth over their lifetime. So, we've created this firm because we feel like there's a gap, because we want to close that gap for investors, and we believe that we can do that. And it's, in part by speaking with companies like Stallion, understanding the products that they deliver and how that can fit for people that most of the time aren't aware that that's even available, and that can deliver great results. And we'd love to do that for our clients.
Yeah, absolutely. I love it. Well, Terri, Where can people find you if they want to know more?
Oh gosh, it's very easy to find us. Our website is www.zumawealth.com. That's Z-U-M-A wealth.com. And the where we got that name is we're based in Malibu, California. And there is an area in Malibu called Zuma that many people love, including us. It's Zuma. It's if you ever come to this neck of the woods, it's a place we highly recommend that you visit. We have clients nationwide, but we wanted to give that local name to our firm. So that's an easy way to learn more. There's a lot of great education and resources on our website. We keep an active blog on there, and you can find great information, ways to contact us exactly through there.
Amazing. Well, if you guys are listening to this and you loved what Terri had to say, you loved her perspective on the markets and just her character and her competence, if you will, make sure to check her out at that link. All of it will be down in the show notes. Thank you guys so much for watching. And Terri, thanks so much for coming on the show.
Thank you, Timmy. It's been an absolute pleasure to speak with you.
Of course. And we will see you guys on the next one.